how much are you able to save. The most important equation in the whole of financial world is expenses is equal to income minus saving. I repeat, expenses is equal to income minus saving. You don't do the other way around. Most people do the other way around where they saving is equal to income minus the expenses that are there. No, you have to save. You have to save very aggressively when you guys are really, really young. You have to spend only that money that you get after saving. That is the first point that we say. Once you have decided how much money that you are able to save, uh, then what you really do is that then you risk profile and find out what is your ability to take risk. The ability to take risk will depend on your life situation. If your life situation is very good, you don't have any responsibilities, any liabilities that are there. Uh, you need to take a very aggressive route to your asset allocation that is there, and you have to go ahead and invest very heavily in equities. If you have dependents, if you have any liabilities that are there, then what really needs to happen is that you need to create a mix of asset classes so that uh, there's no problem as such if one asset class uh, turns out to be a problem.
Yes,
That is the second part.
yes. I just have.
Yes, please go ahead.
Suppose I'm just a millennial. I'm between 25 to 30. That's my age. And basically, I have a saving. Say, suppose I'm able to save around, say, between 20,000 rupees a month. So my allocation steps, if I have to start, and I have a zero knowledge of financial planning, so what will be my priority? Where should I be putting my money? My goal objective is to, of course, have a savings. So should I go for some aggressive bets, like what my friends are doing, something in crypto, something on listed, or first I get my insurances right? And if I get my insurances right, what covers do I take? Because my parents will be between the age of around 55 to 65 as well. They are also growing old. So, what kind of covers I can get, especially if you're an employee or a startup person? Just have a query on that because I think a lot of people would connect with that.
Definitely. Thanks, Sharad, for that question. Definitely. Number one thing is never invest in any asset, be it equity, be it debt, be it crypto. Number one thing is protect yourself. You have to protect yourself from any unforeseen health issues or life issues that may really come up. First, go ahead and invest in insurance that is there. Health insurance is number one thing. Today, we have seen the COVID crisis is creating a lot of havoc for a lot of people that is there. So if God forbid, if anybody undergoes hospitalization and if you have a bill of 5 to 7 lakhs, who is going to pay that bill? Nobody is going to pay that bill on your behalf. For young people who are 20 to 25 years of age, 10 lakh rupee insurance just costs 7 to 8,000 rupees, not more than that. It is very, very cheap to buy, and it is the first thing that you have to buy. No crypto, no equity, no debt, nothing of that sort. The first thing to buy is a health insurance that is there. On your question on your parents, look, your parents at the age of 55 must already have an health insurance. If they don't have a health insurance, let me make it very clear. Many insurance companies do give them health insurance, but you will have to undergo medical checks that is there. That is the first point. The second point is outer limit for any good health insurance policy will be 65 years. Before your parents turn 65, make sure that they have a good health insurance policy. So what the health insurance policy will really do is that it will be renewable up till the entire age that your parents live in this world. So at any point in time, if there is any disease, they will be able to make a claim, and you will be saved from any expenses that may occur from hospitalization. So for old people, a comprehensive policy is sometimes not available. So then what you really do is that you buy the second grade policies which have room rent limit and disease caps that are there. But ensure your the first thing that any young guy should do when he gets money is that insure yourself and insure your parents as soon as possible, because as age goes on, even for your parents, insurance cover will be very difficult to find.
Yes, yes, I get.
Okay, yeah,
Comes
please go
to
ahead.
using, your policies, there are a lot of things, which we are not able to grasp the hidden points. So how do we simplify our
Yes.
decision process?
Yes. So on the health insurance side of it, it is very simple. Buy a policy where there are no caps on the room rent, no caps on any diseases getting treated, no caps on anything. It is very simple to buy a comprehensive policy. Few companies do that. For example, an HDFC Ergo or a Max Bupa or a ICICI Lombard do that. But those policies are generally expensive than the other policies which do have limits on their room rent or diseases that are there. That is the first point. Second point is you need to look at copays. If the policy is giving you copay, you don't really require that policy. You require the health insurance company to pick 100% of the bill in case of any unknown hospitalization that occurs. Uh, on comprehensive policy, there is never a copay. Of course, the premium is higher than a policy where there is copay. But the point is, you are paying for the fact that if in any chance you get hospitalized, you will never have to pick up the bill. So I have done a session on this, and we will do a detailed session on this later as well, where I say how do you buy a health insurance. But broadly, what you see is that you have to search for the term comprehensive policy. Once you search for that term, you will find most providers provide that policy. HDFC does that with a policy called Optima Restore. HDFC Argo does that. Max Bupa does it through a policy called Max Bupa Reassure, and many other insurers do the same. So you have to figure these things out properly. Should not be an issue. And a term plan, if you go on a term plan, it is a very generic term plan. All companies provide the same terms and conditions. So there are no various types of term plan. There's only one type of term plan that is there. But on a health insurance policy, there are different types of health insurance policy that you have to look at. The ones that young guys should look at is called a comprehensive policy. That is there, right? So let us go ahead with what I was saying. Uh, Once you have created a risk profile that is there, then the next point is you have to decide, screen, and think about what are the goals that you have in life. It can be your marriage, it can be your child's marriage, it can be your child's birth, it can be your house. These are the goals, and what is the broad expectation of money that you will require for the goals that you really want. This is a very critical aspect of creating a financial plan. You have to decide what are the goals that you have in life. Everybody has very different goals in life, and you have to evaluate sitting with somebody, uh, somebody who is a financial planner or somebody who uses his common sense. A financial plan is more about common sense than anything else. Most people don't use their common sense. If you use common sense, then it is not very difficult to understand that you may require money for your retirement 20 years, 25 years, or 10 years down the line. It is just common sense. You don't need a financial planner to tell you that. Once you have decided your goals can be X, Y, Z. They can be anything. Buying a car is also a goal for some people. Taking care of the parents is also one of the goals for people. So it can be X, Y, Z, which needs to be really figured out. Once you figure it out, you will then find this is the money that I need at this point in time in my life. This is the money that I need at Y point in time in my life. Once that is done, what you should really do is that you should then move towards something known as asset allocation. What is asset allocation? So we have different types of assets that are there. We have equity, or stock markets or stocks. We have debt products where you have debt mutual funds, you have fixed deposits where you get fixed return. The risk is lower here, so the return is also lower here. On equity, it is very volatile. The risk is higher in the short term, so return may be also higher, or may not be higher. But the point is that equities are far more volatile than a debt product that is there. Then comes the real estate asset class that is there. And then comes the gold asset class that is there. So what really happens is that we do not put cryptos as an asset class because there is no regulation amongst these asset class amongst cryptos that is there, and it will take time for them to get included as an asset class where more and more countries start to accept cryptos as an asset class. But as of now, they're not an asset class as such. So what?
Asset portion, if I may ask. So let's just
Sorry. Yeah,
a
I was
question.
not able to hear you.
Yeah. So
Yeah.
I just have a question on asset class. Let's divide the people into three age groups, okay? Between say
Yeah.
25 to 35, one age group, between 35 to say 45 or 51 age group, and the one who are going to retire from 50 to 65, one age group. So there are three age groups. You earn in early in the, and one is the middle and one is the senior. So how do you, if you had to make some asset allocation strategy on a broader level, from a bird's eye view, what would it be like? Of course debt level should be higher, when you go towards the retirement side. Equity side maybe, higher when you're young. So we would just like to know a little bit, if I had 10 rupees in my pocket, what would I do?
Definitely, I'm getting there. That was the exact thing that I was getting at. So, when you are young, let us get there. Let us start it with a practical experience and let us see how asset allocation varies across uh, a guy who is very young and goes on to retire. Let us say we have a guy who starts very very early in his life, who does not have any responsibilities as such, and is earning and is in mid 20s. Does not have any liabilities, does not have any dependents that are left. Point number one, be very aggressive in equities at this stage in time. When you have nothing to lose and you have a very long compounding cycle in ahead of you, you should be long equities. You should be very aggressive equities. In fact, in many cases, you have 80 to 90% equity allocation that is there. Uh, which is really very aggressive, but if managed correctly should not be a problem. That is the first aspect of it. Of course, there's one thing that we really missed here is that you should create something known as an emergency fund before you get to an asset allocation. An emergency fund is 6 to 12 months of your savings that you should of your expenses that you should always have as an emergency in case of any problems that you may have in the short term, be it a job loss or anything of that sort. So once that is sorted, and when you come to an asset allocation, a very young guy who is from 20s to 30s should be very very aggressive on equities. Uh, Even after 30s, as you go on, you should start investing a little bit in debt, but not too much. You should be giving a lot of your savings towards equities because when you are in 30s and suppose you are going to retire in 60 at 60, if you invest at 30, you give 30 years of compounding time to your portfolio that is there. Generally, that is good enough time to create a lot of wealth that is there, provided you are consistently investing in the markets every month and you are not panicking in good times as well as in bad times. In good times you don't redeem the stocks that you have, and in bad times you don't panic and redeem the stocks. So as you go towards your 40s, the first important decision of your life should be taken. Do you want to buy a house or not? And if you want to buy a house, by the time you are really 40, you should be through with that decision, because in case you want to take a loan, then 20-year time is a very good time horizon to repay your EMI that is set. By the time you are 40, your equity allocation from 90% should move down, because there will be some bit of responsibilities that you would be taking up. So from that point of view, you should be bringing down your equity allocation to, let's say, somewhere between from 90% to 75. Look, this is a very generic example that is there. Every example is unique. Every example is different. But the broader point needs to be understood that when you are very young, be aggressive equities. When you go towards the mid age of your life, start bringing your equity allocation a little bit down, not too much, but a little bit down, and start increasing your debt allocation that is there. By the time you are 40, decide on a house. If you want to, it's a very person to person thing as to they want to buy a house or they want to rent a house. There's no clear answer for this. Everybody has their own choices that are there. So the point is that you decide what you want to really do. Buy a house by 40s, decide it, buy the house and start paying the EMIs. If you don't want to buy a house, then you have to increasingly go ahead and invest in equities. You don't have to, while building a debt allocation that is there, the excess money that could have been used to buy a house should also go to equities that is there. So by the time you are 50, your equity portfolio should be big enough, because you are already investing for 20 years of your life. your equity allocation should not be a problem. And by the time you are 45 to 50, your equity allocation should start coming down. Now we are in that age of life where we want to protect the money that is there rather than grow your money, because in the next 10 years you should start to retire. By the time you are 60, you will retire. So the point is that 50 is the age where you should start to, your financial plan should have taken shape, and you are just playing the last part of your financial plan, where you are winding up, you are retiring, preparing to bring down your equity allocation to zero from 50 to 60. Slowly but steadily, your equity allocations should start coming down as you approach 60. And after 60, your debt allocation should be the only predominant thing that should be there inside your portfolio, not too much of equities. In fact, not equities at all. You cannot afford to take any risk with the money that you have got. You have to play with very safe products that is there, and that across a life cycle you should be playing out the theme. Of course, everybody will be very uniquely placed. Some people can take risk even at 40, 45, 50. Some people cannot even take risk at 30 because they have too many responsibilities on them that is there. So everybody is very, very unique.
Yeah.
You have to evaluate your life situation that
So
is
yes, I just need to add something. Like if you just broadly
there.
break up, your first half of your life, say from 25 to 50 odd percent. So you don't time the market so much, but you literally stay invested in it, no, in order to create a long term wealth. And the moment you hit 50, then your approach from wealth creation moves to wealth preservation. That's all we are saying. But a couple of interesting trends was there, and I was speaking with a lot of people. We, because the capital is not so much, if you ask a 25 or a 30-year-old person, that person would rely on compounding. Say, I give an SIP of 5,000 rupees for a XYZ mutual fund. But suddenly, when we are in a bull market and everyone's like hopes come up, so the people who are actually in the older category who have the capital, they start removing their allocation from debt and they come to riskier asset and equity. So what's your take on that? Because human behavior changes according to the market cycles as well. So just an interesting point of view some people had raised earlier. So I just wanted your view on that and how that discipline you can get into it, because financial planning is a very disciplined stuff. So how do keep that going on? It's a long term game. It's not a sprint, it's a marathon, right?
Definitely, it is. So I will quote somebody known as Kenneth Andrade. He is a top fund manager in the country, somebody who is widely respected across industry. So he says this: retail money is very counter-cyclical in nature. When the market is near the top and everybody is making money, retail money will come into the markets. When the market is near the bottom and the risk is very, very low, retail will be very, very shy to put in money because retail will be very scared if the market will go down. So the point here is this: a bull market or a bear market has nothing to do with your financial plan. Your financial plan has everything to do with you. It is your life situation that decides what money goes into equities. It is not what the market is doing that decides what goes into uh, equities or what goes into debt. That is the first point that is said. Number two point is only those people who are very disciplined at the end of the day win in life. Those who are not disciplined in terms of managing their money well will always have money problems. That is there. The most successful investors, the most successful entrepreneurs, or anybody who is out there have one thing in common, that they are very financially disciplined. And nothing today, there's a bull market in the stock markets right now. It does not mean anything. I have had calls from people who told me that should we invest our emergency corpus into the markets? Absolutely not. You should never invest your emergency corpus into the market. Be very, very disciplined. Do not break anything. If you stay disciplined, the market will reward you. If you don't stay disciplined, the market will at some point come and it will bite you, right? So that's what it is. That's how it plays.
Yes,
uh,
I need to add.
okay, yeah, please go ahead.
Yeah, so basically,
Yeah, please go
of
ahead.
my friends are there in the startup space, some are in product. So all these people at times they are into this high stage growth models and they keep on telling me, Sharad, yeah, I need to retire early by 35, 40. So are these dreams or can it be actually done by someone who is, working, or maybe he's in a startup and he takes away his ESOPs? What do you think is this concept of retiring early? Like, hey, I want to retire at 45. Because post COVID, our mindset has changed towards life. It's not always about the hustle or, completing a job till 60. Generally, we take that, that point and we decide things. But somebody who's trying to earn and maybe, hey, I want to retire at 40. How do I do it? So, what will be your take as a financial?
As a financial planner, you have to set your goals which are with respect to your income, which are with respect to your savings, which are very real, which are don't set goals which are unreal in life, which cannot be achieved without taking spectacular risk inside the market. That is point number one. Everybody wants to get financially independent, but nobody wants to work towards it in a disciplined way. This is what I have learned after I have created hundreds of financial plans. You want to get retired by the age of 45? Let's do this. You save 80 to 90% of whatever your salary is. You stay invested in the market and you don't do anything that scares you and makes you go outside the market. You give the market 10 to 15 years of compounding, the market will reward you. 10 to 15 years of compounding, I will tell you personally, has worked for me. We were nowhere when I started in 2008, and we are at a very good place right now. It is all because of the markets. Compounding has worked for us. Compounding works for a lot of people. Some people say that it does not work on a mutual fund. It is not the case. I have seen some mutual funds from 1990s have a CAGR of 25%. So the point is that you have to be disciplined. You will get financial independence only when you work towards it, only when you are very, very disciplined. That is it. Can you achieve it by the age of 40? Definitely, yes. You have to start really young. You have to continuously invest in the markets, be very aggressive in the market. Uh, then things will work out. If you are not disciplined, you are pulling in money, pulling out money, pulling in money, pulling out money, it will not work. To win the game, let me give you a quote that Monica Allen has put her in her book, which is super. She's a very good author, and anybody who is interested in financial planning should read the book that she's authored. She says this: in order to win it, you have to be always be in the game. If you are not in the game, you will never win it. Be it bull market, bear market, you have to be continuously stay invested, and that's a simple way to do it. Simple way to create financial freedom. That is it, right? So that's that. Before I move on to the question and answer session, I just want to wrap the session up by telling you what is the summary of what you should do while starting to create a financial plan. Number one, uh, don't invest in the market straight away. First, invest in an insurance, be it life insurance or health insurance. That is the first point that is there. Second point is you create something known as an emergency corpus that is there. 6 to 12 months of your savings should be invested in a debt product that is there, which is readily accessible in case of any emergency that is there. For example, a lot of people lost their jobs in COVID during the first lockdown that is there. Such funds help in those times when you don't have any income that is coming in while you are searching in for a new job that is there. That is the second point that you should be doing. The third point that you should be doing is income expense tabulation needs to be done. You need to figure out how much are you saving, and saving is equal to income minus the uh, uh, expenses is equal to income minus the savings that you have got. Once this is all done, try to find out what are your goals. Your goal can be your retirement, your goal can be your child's education, your goal can be anything that you really want. That needs to be tabulated down. Once that is done, what you then should be really doing is that you should move towards your risk profile in order to find out what is your risk profile, how much risk are you able to tolerate, how much risk your portfolio is able to take in order to generate the returns that you want. That is the next part of it. And then finally, you should be moving towards an asset allocation, where on the asset allocation, young guys, extremely aggressive equities. As life moderates, as life goes on, equity allocation must moderate out. But the broader point is equity allocation must get a time of 10, 15, 20 years to compound really well. And by the time you move towards late 50s, your equity allocation should start to fall drastically, and you should start to move towards the debt allocation part of it. And a financial plan is not a one time job. It needs to be continuously monitored. It needs to be seen uh, as and when your life situation changes, how your financial plan is going to adapt to those changes. And uh, it is a continuous process which should be evaluated every 3 to 6 months, depending on the situation of the person that is there. So that's all about financial planning that is there. Everybody should create it. Everybody should create one financial plan so that you never have a problem in the inflow and the outflow of money that is there.
Yes, I have a question. So I suppose I create a financial plan. So do I review it like say 6 months, once a year, or according to my goals, maybe every 1 month? How do I go about it? Because it's a long term process. Suppose if I do my financial plan. So how do I get reviewed? Do I do it alone? Take everything on myself, or do I go to a financial planner? And if yes, how do I review it?
Look, the first point is how often do you review it? Generally, you review it every 3 months. If there is no change as such, it can be done within 6 months as well. But it needs to be periodically reviewed. That is the first point. It has to be reviewed at important phases of your life. Suppose somebody's got married, it has to be reviewed then. Suppose somebody has a kid, it needs to be reviewed then. If somebody has a change in job, whether salary is going up or down, it needs to be reviewed at every important point in your life. When there is something that is changing out, you need to review your financial plan and see if things are aligning exactly the way you had said before. That is the first point. How you should create a financial plan. Look, uh, point number one is you spend some money and get it done by a financial planner. That is the best part of it. For those who don't really want to spend in money, the first point is that this is all about common sense. If you are able to uh, do this using your own common sense, well and good. But don't stretch it too far. Don't take decisions about which you don't have a understanding. Go to a financial planner. Financial planners are not that expensive. If you have a lot of money, financial planning is the first thing that you should be really doing.
Yes, at times what happens is my friends are investing or they are going into small case and we are doing a herd mentality, buying a cracking penny stock. So how do we reduce this kind of because all our goals are very different, but then the herd mentality comes in, especially in this bull run which we are seeing. So how do I reduce my temptation? Because right now I can take in the losses. I am just 26, 27. I can take the losses, but maybe when my family is there, or maybe I have expenses with kids, then what would be my approach? Because I'm seeing this behavior not only in between 20s odd people. I'm seeing this behavior amongst people who are in 40s. They are going into unlisted space. They are taking higher risky bets. They're talking about crypto. So is the mindset changing, or are we getting indisciplined? That's the main question, I feel.
Uh, Today, what is really happening is that everybody is wanting to have a piece of the things that are going up, and that's about it. In discipline, 99.99% people in the stock markets or in financial markets are indisciplined. Be it brokers, be it anybody else who is out there. Let me give you an example of why Rakesh Jhunjhunwala is really successful. Today, everybody is seeing he's meeting the prime minister. Let me give you an example. He bought Titan shares in 2003 at a price of nothing, absolutely nothing. In 2008, when the stock was down 80%, he never sold a share. And that is why he is today Rakesh Jhunjhunwala. He is ultimately the most disciplined investor that is out there, and that is why he makes money. Today, he speculates on poor quality stocks as well, but he has got sufficient amount of exposure to high quality stocks which will never fail him, that he does not worry about all those things that are there. So the point is, only disciplined investors win in the stock market. Those who are not disciplined, the market is smart enough to take money out of that. You should know this. You can never outwit the market. The market is the smartest animal that is out there. Those who are not disciplined will go away. Those who are disciplined will survive for the next 10, 15, 20 years. And those who survive will always make money.
That's a great analogy. I think yes, that's a any kind of hacks are there which which we can take in any hacks for for financial planning.
Yes. Yes. Some of the hacks that are really there is that, look, point number one is avoid debt as much as possible. Do not take loans from banks. Loans from bank work on a reverse compounding basis. You take X loan, you will end up paying 2X in the period of loan repayment that is there that you will have to take. That is the first point that is there. Always try to buy assets that are appreciating and not depreciating. Do not invest too much in a mobile phone or a car or any asset that reduces in value. Buy assets that are always appreciating, be it a real estate or be it a equity, be it a debt, whatever it is. Invest in these kind of things rather than not having money and trying to buy an iPhone. It will not solve your problem. It may look good in the short term, but it will not look good in the long term. That is there. That is the second point. The third point, which a lot of people miss, never miss your insurance renewal premiums that are there. If your insurance lapses and you have a health problem, the insurance company will never come back and give you the insurance policy. You will have to go uh, again, repeat all the checks, all the tests that the insurance companies really want to do, and that will be a problem. The fourth hack is never be concerned about a bull market or a bear market. Continue your SIP. Mutual fund, if you are investing through a mutual fund, go ahead and invest in your mutual fund. Do not stop your SIPs for at least 10 years. Do not change your mutual fund without giving them a proper chance. There will be periods of outperformance and underperformance. Don't worry. Don't chase the best performing fund every year. It is not going to happen. For example, the best performing fund today will be destined to underperform in the next 2, 3 years. So don't worry about that. Be very simple in the markets. Don't try to follow any complex strategies that are there. Invest in 2, 3 mutual funds, pick them up, SIP them for 10 years, and I'm sure that all of you will do really well. Should not be a problem as such.
Yes, this is a golden treasure of knowledge which you have given. I think as indisciplined as I'm a markets person for the last 10 odd years, an investor for 9 years. Still, my indiscipline kicks in, and nowadays what happens is I'm on credit. I'm doing my credit card bills. At times I'm missing my payments, and now this new concept has come, which suddenly has sparked up my eyes. Buy now, pay later schemes. Something below 5 lakhs, any damn thing I can buy and take a 30-day or a 40-day relapse rather than paying it. So what is your take on it? Because most of our consumption patterns are changing now. We are looking at more cashbacks, and buy now pay later is trying to cover that area. So we as a generation are moving towards some new credit venues and methods. So how do we get that discipline into it? Because this discipline is a very traditional form of discipline. So do we crack a balance to it, or do we stick to the roots which is there, earlier, which was there?
You know what? Uh, I'm a great follower of Mr. Warren Buffett. Uh, I only tell this to myself. If you buy things that you don't need, you will end up selling things that you really need. And that is what should motivate you. That is the first point of it. The second point of it is that nobody can teach you discipline. You yourself have to teach yourself discipline. That is the second part of it. Sit and do nothing. How difficult is it? It is not very difficult. You have to go. You have to not stop your SIPs. At the start of the month, if you get 100 rupees, straight put 30, 40 rupees into an SIP. That money is gone. You can never see that money. Every month on the day you get your salary, schedule an SIP. If you do that, you will find that you only have the money that is uh, expenses that are income minus the savings that is there, and keep on increasing every year by 10%, 15%, whatever is uh, on the whatever increases that you get in your salary. But the broader point is nobody can teach you discipline. Discipline has to come from within. Not doing crazy stuff has to come from within. Not trying to buy an iPhone and rather going and investing in uh, a mutual fund in India or in the Apple stock in the United States has to come from within. Has to come from either your financial planner or your what do you say, or the stock investor, stock advisor that you really. So that's that. I will end again by saying that Warren Buffett has a famous quote which says that if you keep buying things that you don't really require, you will end up selling the things that you really
Yes.
require,
Okay.
right?
I think Aditya, he's a stakeholder relations head at JST Investments. He would like to, open the floor. I'm sure everyone is having a lot of questions in their mind. And me, AS, AK, and even Anish, who's the head of research at JST Investments, if it's stock related, sector related, we are free to open the question and answer round. And please feel free to throw your questions. It can be anything. Don't feel shy to ask any question. All questions are important and relevant, so we can shoot. Aditya, please take over.
Thank you, Ace, for the presentation, and thank you, Sharath, for the introduction and the moderation. So, guys, I'm just going to add speakers and they can ask their questions, please. Kiran, we have made you a speaker. Your question, please. Khushbu, we have made you a speaker as well. Your question, please.
Hi everyone. Thank you so much for adding me as a speaker. So I was just listening to the conversation and it was pointed out that first of all we should invest money in the insurances and then put out some emergency fund. But after it, what should be the strategy of a beginner? And at what point should how many hours should I be able to invest in one day? And if I cannot put in those minimum hours, after what stage should I consider having a financial advisor?
Look, it is advisable that you get a financial planner if you don't have expertise on this. What you should really do once you have the insurance and the emergency corpus that is in place is that you should be looking at tabulating whatever income expenses you really have and what is the kind of saving that you will be able to make. Once you have done that, then you should be moving on to whatever your goals are. All through your life, since I assume that you are very, very young, all through your life, you will have multiple goals that will come up, be it your marriage, be it your children, be it their education, be it buying a home, or be it anything, be it your retirement. So you have to figure out what is the kind of corpus based on your current lifestyle you will require at that point in time, and then you should be figuring out what will it take to get there. That is that. A risk profile then is a must. How your risk profile? What is the ability of your ability to take risks that is there? Uh, that is one aspect of it, and then you should be moving towards an asset allocation. If things look a little bit complex, I will suggest don't do it on your own. Try to get a financial planner doing this for you. But if you do search Google, you will find a lot of ways to do it. But again, a Google is just like a Google Doctor that is there. It is the same thing. I will not suggest you to do it, but only for those who are very, very well versed in this topic. They should go ahead and do it alone. Otherwise, get a planner.
Thank you so much for answering. I just have one more follow up question, which is regarding public provident fund. So, like my employer
Yes.
already, and I also invest in provident fund. Like it's a mandatory cut that goes from my salary. But apart from it, should I invest in PPF? My concerns were like I know it helps in saving tax, but then it is something that I'll get after 15 years, and that is 15 years is a
15
huge
years.
time. And since I'm pretty young, I can take more risk. So should I put that money in some place else, which might have a possibility of giving me more returns? Or since PPF is a safe option, should I go for it?
Yes. Look, it's a very good question. The first point is PPF is an excellent product that is out there. It is the only product out there which is exempt from taxation. It is exempt when the money goes in. It is exempt. The interest that you get on it is exempt, and when you take out, it is exempt from taxation. It is completely exempt from taxation. That is the first point that is there. Over the long term, it is really a good product to look at the debt side of it. There are two ways to look at it. There should be some money that should be locked in that you should not be able to touch, because every penny that you have, you are able to touch. It may be possible that you spend it the wrong way. The other aspect of it is that if under Section 80C you want to save 150,000, that is permissible by law. You can do it under an ELSS scheme that is there. But apart from that ELSS scheme, the best option is a provident fund that is
I
there.
think I just need to add one
Sorry.
thing, Khushbu. There are two tax regimes as well. So the we are
Yes,
talking
definitely.
right now is for the old tax regime.
Old taxes.
So this is
Yes.
if it's already like suppose I'm assuming last 3 years you have been earning say 10 rupees. So 1.5 rupees you have been already paying as for PF. So on a personal as a advisor it would be necessary that you should continue this and don't break the bigger amount. So what happens is that compounds, or if you are in the new regime and you have just started earning, then you have the ability to whether to take it or not. So there is a two different view to it. So if you have been already in the job market say last 1 2 years and you have been paying 1.5 lakhs as PF and getting the tax deduction, then it makes sense. New one you have the option. So of course new one also it's supposed to be done, but the new regime is for the new people earning in say earning between 10 lakhs per annum. So for them it's a bit different. So we need to understand as financial planners which regime of tax you come. So that does make a difference. If somebody is making 10 lakhs an annum, there's almost a difference of say 30 to 40,000 in taxes paid. So that is something tax planning also comes in, and I think AK would give a very better understanding of it. But we can discuss it offline, and we'll go for other questions as well. Yes.
Sure. Thank you so much
Yes,
for
yes, go ahead.
answering.
Yeah.
Thanks.
Santosh, we have added you as a speaker. Santosh, your question, please.
Hello, good evening, team. I am Santosh Kumar, and the conversation was very well, sir. I have a small question for the sir.
Yes, please.
I have very little knowledge about the financial planning, but as the topic was on, I soon picked. I was on the team, sir. I'm a recent investor in the equity market. I have chosen as the IPO as the basic point, so because I do not know much about, so just with small amount of money, I have entered in the market. Recently, I got one such IPO, sir. Should I hold the IPO after I got the listing, sir? If you're for long term or any minimal gains, we should sell it off, sir.
Look, if you don't know anything about the markets, I will not suggest you to go and invest in the markets on your own. Try investing in a mutual fund. Try investing in something known as an index fund. If you have don't no expertise, no going on your own. Try the mutual fund or an index fund is your best bet that is out there. Don't worry about anything. Go ahead, choose a fund. If you don't know how to choose a fund, invest in something known as a Nifty 50 index fund that is there, and that's about it. IPOs or no IPOs, don't invest as such without having any knowledge about the markets.
Santosh, I may just add, it's a risk return is not that much because the allocations which are there when you apply for an IPO, it's not that you get a lot of lots. You get lots worth between 14,000 to 15,000 for a main board IPO. So even if you make a listing gain, that would be just enough to suffice you for a Saturday night party. That's all. So there is nothing. We used to do that in college. I remember. Yeah, AK was there in that. So that is the portion unless you're doing an HNI allocation, which is very difficult to get itself. And right now the IPO market is very hot. Now you must say that yeah, unlisted markets maybe to kharid sakte. So there's a lot of risk involved. So post the listing, you can actually have a look whether the stock is good or not. See, Zomato hasn't increased yet. It had a bumper IPO. What happened? So you need to understand, where the buzz is and where are the stocks, which can go. For that, you need a lot of effort. So if you don't have that financial knowledge, then it's must that you go through a financial planner who not only first will get you in the markets via mutual funds and safe instruments, then maybe when you understand a bit more, then they will expose you to equity exposure. And we are right now currently the markets are very expensive. So buying expensive thing and making it more won't make you a lot of money. So we wait for correction or a lot of things can happen, but then go through the financial planner since you're a beginner. That's what I'm assuming.
Yeah. Parshva, we have added you as a speaker. Your question, please. Ajay, we have added you as a speaker as well. Your question, please.
This is Ashok.
Uh, okay, Parshva, can you ask a question, please? Yeah.
Yeah, hello. I am recently qualified chartered accountant. Actually, I have two questions regarding financial markets. Like nowadays, there's a trend of
Parshva, sorry to
Yes,
interrupt, but
yes, I'll make out.
your voice is not really audible. Can we
yeah.
request you
Is
to
my
use
voice
a
now audible?
earphone uh, a bit better, but still not audible?
Is my voice now audible? Hello?
Yeah, it's better now.
Hello?
Can you go ahead with your question now? Yeah.
Yeah. My question is that nowadays there is a trend of people doing CFA every now and then to enter into financial markets and pursue jobs into markets. So is it necessary for everyone to do CFA and get into markets, or what is the scene actually?
No, I will not. Let's not get to these topics. Let us stick to the uh, topic that we are discussing here. That is another topic, another time for it another day. But today we are talking about creating a financial plan, and that is more important.
Ajay, your question, please.
Yeah, thank you for giving me the opportunity to ask a question. I just wanted to know that what percentage of my savings should I invest in the market? Currently, I have the index fund, but I want to increase that, the position in the market. So, what should be the approach?
It is very simple. As I have already said, that your expenses should be your income minus the saving. Save as much as you can. Uh, the more you save at a very young age, the more it will compound and the more it will benefit you in later stages of your life. So the point is, how much should you save? There is no clear answer to it. Some people are able to save 20%, some people are able to save 50%, some people are able to save 60%.
Yeah.
Cut down on every discretionary, cut down on every discretionary. AK, what happened?
Yeah, you go ahead, please. There was a distortion coming from his end.
Is the voice very
Yeah,
clear?
yeah. For you, it's clear. Yeah.
Yeah. Yeah, cut down on every discretionary spending that is there. Maintain a very basic lifestyle, and then you will find you have a lot of money to save. Cut down on if you were going out 5 days a week, 5 days a month. Before, go 3 days a month and try to save the money that you were spending the 2 days of your life. Try to have a very basic life in the early stages of your life. Then, as you are able to create a corpus, then you can enjoy life. But in the starting phases of your life, you have to be very, very aggressive in saving. There should be no doubt about it. If you don't have a good corpus, you must save aggressively in the early stages of your life.
Sure. Ravi, we have added you as a speaker. Your question, please. Jayesh, we have added you as a speaker. Your question, please. Kiran, Ravi, and Jayesh, you guys are speakers, so any one of you can ask
Yeah,
a question. Yeah.
yeah, Ravi. Yeah, should I go ahead?
Yeah, please.
Yeah, hi. I have a question. You see, I do invest in equity, but in, like, small quantities. Like every month, I try to invest like 20-30,000. But my question is, like, let's say, for example, I've chosen few stocks, like, 10-15 stocks, and I'm buying 5-10 quantities, and every month. What I should be looking at, let's say, for example, I bought one stock today, and it's going up and up and up. So what should be my approach? Like, where I should continue to buy that again in the next month, or should I invest like 25K in one stock in a month, and then like that, I mean,
Well,
how
I
should
will answer this. Ravi, the thing is, it depends what stocks you are investing on and how many months you have been actually already investing. So, I'm assuming you're investing in blue chip stocks. So you can continue that. the cycles maybe, and it's a market leader, something like that, which generally people do of stock SIPs. Or it depends which stocks you're doing. So if you can explain which type of stocks are there, or if you're doing a momentum stocks, then it's very different. And if you have rightly said, stocks go up and up, but they also go down and down. So if you're able to get that emotion in, then maybe you're sorted for the markets. But if you're new to it and you have less financial knowledge, then why not go through a financial planner?
Yeah, so just to give you a little background, I have worked as a trader on NYSE and Nasdaq. I mean, that's that was my first job, so I know little bit of trading, and then I moved to Indian market like maybe in late 2018 somewhere, and since then I'm kind of building it up. Like I have like 6-7 lakh of portfolio now. A few are like, for example, CDSL I have, like Loros Lab I have, Tata Power I have, Reliance I have, like that, few like mid cap, or we can say few blue chip companies. And I mean, I have my own, by reading you guys like JST and all those people, I try to analyze and read myself and try to understand. I mean, it's still learning phase, but yeah, so this is how it's been. For example, I bought this CDSL around 600 level. Then I kept on adding, and now it's 1200. So should I, because my price is going up and up, like average up we call it, right? So what should be the approach?
The approach will be discussed by the financial planner, but
Uh-huh.
it depends on your goal and objective. For someone, it can be 2x. For somebody, he can be a value investor at maybe a 10x.
Mhm.
For a short investor, it could be like 30% return. So it depends on your objective, what you want.
Yeah, I'm looking at around 10 to 15 year of time horizon.
So if you sit on time, the money will increase. Now you should know which kind of stock it is, or which kind of growth potential it has.
Mhm.
Now there are some stocks which have been sitting of Reliance, which are like 90% down.
Mhm.
So you have to sit at the right place at the right time.
Yeah, but we can't, right? Sometimes one stock will go up.
Look,
It's cyclical, no?
look, okay. Okay, let me interject here completely. If you don't have knowledge about when to buy or sell a stock, you should not be doing it directly. That is the first point that is there. Uh, if you are able to analyze these stocks correctly, you should be knowing that when to average up, when to average down, or when to buy or when to sell. If that is not the case, then you need to really spend time in the markets, because this is a bull phase that is there. In bull phase, everything goes up. In bear phase, you will find out that things don't really go up. So my suggestion to you will be this: it should be very crystal clear. If you have these questions, then it is very well suggested that for us, we don't advise you to go direct equity straight away. What we suggest is that you should be investing in an index fund or a mutual fund that is out there. That should be your route to taking equity exposure in the while that you keep learning, because the mistakes that are made today will only get exposed when a bear market comes in.
Awesome. Uh, Jayesh, can we request you to ask your question, or
Yeah.
Kiranji,
Hi,
you
hi
please?
Aditya. Kiran here.
Yeah, Kiranji, please.
Yeah.
We can hear
Yeah,
you.
hi.
Yeah. Thanks for the session. So I have two questions. One is at insurance part. Like selecting an health insurance is a little complex as an individual. More terms and condition apply. So if you give some scheme names, it will be much helpful. Even you have said like HDFC Ergo and Max Bumper. Under that brand, there are many schemes. So can you give some names for reference, scheme names? And second question is like. As people say, the market works on cycle. So the new investor will only be in seen the bull phase. So how does actually the market works, and how to prepare for the next cycle? Thank you.
Okay. I have given you the names already. It is HDFC Ergo Optima Store, or it is Max Rupa Reassure policy. It's a comprehensive policy. You must do some work and search about these policies online. That is the first part of it. The second part of it is the only guarantee that is there inside the stock market is this. Uh, After a bull phase comes a bear phase, and after a bear phase comes a bull phase. Back in 2017, there was a bull phase. 2018-19, and after March of 2020 was extremely bad for the markets. People were bleeding like crazy in stocks. 2020 to 2021 was a bull phase that is there. If you don't have experience in the market, you do this. Like you put money in the bank, you put money in a mutual fund and let them manage it for you. Increasingly, what I find is that people are trying to go direct to equity without having any knowledge. Investing in the market is like going to the doctor. You don't go to the doctor, you don't eat a medicine without going to a doctor. Similarly, you don't go and invest in the market without having a specialized doctor, which is done by a mutual fund or a stock or advisor that is there. Without that, don't go inside the market.
Thanks for the question.
Uh, Jayesh ji, your question, please.
Sure. Thank you so much for the opportunity. And team, I would like to say that you guys are doing a great job. And I've been doing the same thing for the last 5 years. When I started doing my job, I've been putting, starting from a small amount into SIP. And now it has come out with a huge fund value. My question to you is I have never taken a loan and I've stayed away with all the loan that, that are there, but my dad has taken loan for around 20 years now, and 10 years we are already paying money. So now that I have huge amount in my mutual fund, should I think of paying off that loan value right now, or should I keep on adding money right now?
Again, a very subjective question. I, as a financial planner, don't like a loan on my client. So I say to my clients that pay off the loans that you have got. Again, it is a very subjective question. It depends on you. I don't like a hanging sword on me, which is the sword of an interest. It all depends on you. A loan interest, whatever interest that you are paying, is a surety that will come every month to you. Will equity returns come to you? The answer is I don't know. If you don't know on one part of your you have an asset and you have a liability. Your liability is your loan, your asset is the money that you have. On the asset, on the money that you have, what return that you will get, you don't know. But on the liability that you have, the loan that you will have to pay, the interest is already decided at 8 to 10%. So I don't like to mismatch the asset and the liability, so I like to repay the loans. But it is a very subjective question. Some people don't like to repay the loan and take risks, but I generally am very, very conservative in it.
But at this time, when the market is at all time high, and everyone is saying that there might be a a small maybe a correction happening. So is it advisable to take off some amount from the market and pay off maybe a little bit of your loan?
Okay, let me give you two things. As I said that I follow Warren Buffett very closely. Only two people know what is going to happen inside the market. One is God and one is liar. So nobody knows what happens in the market in the short term. Uh, Market moves up and then people start creating a narrative. Nobody has a clue what happens in the market. It is a very subjective thing. So I will not like to comment what happens inside the market.
I think we'll end the questions here. Thank you very much, Jayesh, for your question. And I would just like to thank each and every one of you. Almost 200 listeners we have, and you're taking out your time, giving us more than an hour. So almost 66 minutes into the session, and you have been a very patient audience. So thank you very much, for listening. And I really wish a really nice financial planning, your entire setup, for the future. And just to sum up the entire conversation, I think A has discussed about the risk profile, your goals, your asset allocation, your emergency fund. So these are the pointers which you can take away and understand how important this is going ahead. And lastly, I would like to thank the team JST Investments. AS is of course the forefront runner, the CIO, and he's the chief planner also. Anish is the head of research. Do follow his tweets on the markets, especially the equity side. And Aditya is there for IPOs, and IPO season is very hot. So do follow him. And lastly, thank you very much for all of you to be a part of it. And I think we'll do more sessions on personal finance, financial planning. And I think I want JST Investments to give out some resources in their tweets. If I want to do without a financial planner as well, which book should I follow? So I think this is a very interesting proposition, and there will always be discipline versus indiscipline, and it's up to the individual. But remember, it's a one-on-one thing with a financial planner. So every app, every tech is there in the market, but at the end, it's your own hard-earned money. So be careful of it. Whether you earn 10,000 rupees a month as a BPO employee, or you are someone from McKinsey making 32 lakhs or 40 lakhs per year, you need to plan your finances. Thank you very much, guys, for taking out your time, and we'll leave it till here. Thank you very much.